is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. Well, blame game. UK Chancellor Kwasi Kwarteng says the BOE will be responsible if markets tank after its bond buying program ends. All eyes on CPI. Stocks fluctuate before today's critical U.S. inflation print. Fed minutes show a commitment to restrictive rate hikes. Plus, as OPEC trims its demand outlook, U.S. officials fear that the Russian oil price cap plan may fail. Putin warns all global energy infrastructure is at risk. Now let's check in on the markets. We're also getting the IEA report crossing now on the Bloomberg terminal, so we'll get that to you as soon as it breaks. European stocks a bit under pressure, down 0.4%. The focus firmly on what we're seeing with US CPI a little bit later. So you're seeing a lot of equities actually extending some of the decline. Caution prevailing before that highly anticipated U.S. inflation talk. The focus also on the UK 30-year yield. We're now hearing pension funds on what they can do to try and get facility. The main concern, of course, is liquidity out there. Corporates may be asking, or regulators may be asking corporates to put money into their pension funds to make sure that they're okay. The blame game between Treasury and, of course, Bank of England absolutely not helping. And then finally, we look at pound 110.85. The focus firmly, though, on oil. OPEC Plus cutting the risk to the oil price spike and world recession. This is a warning from the IEA. So we'll have a full round on what happens to the IEA. I think we have a European map, but it'd be nice also to look at the price of oil maybe on a one-month chart. So the FTSE gaining, or actually down some 0.5%, a similar loss for the CAC 40. So that's a picture across the board for the IEA. We'll have plenty more, of course, on what we heard from them. IEA warning that OPEC Plus cuts risk oil price spike and they risk a world recession. So the Chancellor, Kwasi Kwarteng, says the Bank of England would be responsible for any market volatility after its bond buying program ends tomorrow. Now, speaking on the sidelines of the IMF's annual meeting, the Chancellor told Sky News that any turmoil is, quote, a matter for the governor. Well, economists and bankers gave us their take on what is going on.
We've announced that we will be out by the end of this week. You've got 3 days left now. You've got to get this done.
The Bank of England can talk tough, but fundamentally, they're just going to have to extend this.
They are trying to hold things together as best they can.
The confusion, I think, comes between the financial side of the Bank of England and the monetary side of the Bank of England, which are now trying to do different things.
Monetary and fiscal policy being at crossroads, at cross purposes with each other, that's a very dangerous cocktail for bond markets.
It's been trying to maintain price stability and at the same time address financial stability issues with this other instrument.
This is not yet looking to me like a very steep and deep recession.
I don't think we're at risk of a financial crisis.
I worry that this is not enough, and I think they're going to have to come up with their version of whatever it takes.
By this time next year, the Bank of England will probably be cutting interest rates.
Well, for more on this, let's bring Bloomberg's Lizzie Burden. Lizzie, it seems that the Chancellor and the Governor are playing a game of chicken. What happens next?
Well, you've got the pressure on the government to U-turn on their tax cuts because, of course, in Prime Minister's questions yesterday, Liz Truss said she's not going to cut spending. So if she wants to balance the books and restore any credibility in markets, she's going to have to change something. Newspapers reporting that corporation tax could be the next reversal. And then on the Bank of England side, again, Andrew Bailey under massive pressure to U-turn. He came out guns blazing this week saying that the emergency bond buying programme is going to end tomorrow. But now Kwasi Kwarteng saying if the market turmoil continues, it's going to be on Bailey. If Bailey has to continue the programme, then it's going to risk his credibility and it would mean that he isn't able to fully fight inflation. And the chief economist, Hugh Pill, said this week that that needs to be the BOE's priority. So you have to ask how much of a U-turn from the Bank of England, if there is a U-turn, how much of an effect, of a spillover effect there would be in terms of monetary policy, because markets have to believe what the governor says.
What options does Bailey have now?
Well, he could continue with the gamble, end the programme on Monday and hope that the market turmoil ends. He could fold, he could continue the programme, but as I say, that has risks for credibility. He could stop or delay quantitative tightening, but again, that means he can't fight inflation. or perhaps there's a creative solution to be had. This is what strategists at HSBC are saying, where the Debt Management Office, which is part of the or works as part of the Treasury, buys shorter dated money to ease up space at the long end. Really, that hasn't yet been formally been put on the table, but what it shows is all through the summer, the Bank of England was criticised for not doing enough to fight inflation. Then the government seemed to row back on that and said that independence was sacrosanct. As it stands, the Bank of England can't be fighting inflation effectively, nor is it looking as if it's independent from fiscal policy. Bailey in a very difficult place.
Certainly. Lizzie, thank you so much. Lizzie Burden there outside the Bank of England on Threadneedle Street. Now, the deterioration of the global economy and higher prices sparked by an OPEC Plus plan to cut supply will slow world oil demand. That's according to the monthly report from the International Energy Agency. Now, it comes as sources say that some Biden administration officials are growing concerns that their plan to cap the price of oil purchase from Russia may actually backfire after the OPEC Plus alliance's surprise production cut last week. Now we're joined now by Toril Bosoni, of course, head of the IEA's oil market division. Toril, thank you so much for joining us. First of all, it's a pretty stark warning when it comes to what we saw over last month. And I know you're worried about a global recession. Where would you see it first?
We're already seeing the economy faltering here in Europe, in the US. All the major institutions continue to downgrade their outlook for the economy on a monthly basis. So what we're trying to say with this report, the higher prices feeding into inflation, forcing governments to cut interest rates, we're saying that the macroeconomic environment might deteriorate further.
So, Toril, talk to me a little bit about what we see next. I know, if we look at the production cuts caused by OPEC or put in place by OPEC that might cause a recession, are you actually calling OPEC Plus to reverse course?
We're not calling on OPEC we're not setting their policy. Obviously, this is for the OPEC to decide. What we're saying is that by cutting supplies to the market, it's preventing a rebuilding of inventories that are still critically low. So we think that by reducing supply at this time, the lower inventories, OECD inventories is still some 240 million barrels below the 5-year average. And they would have been even much lower than that had it not been for IEA member country stock releases. So we think that if we were allowed to let the inventories rebuild, it would be help to reduce the volatility and deflate the inflationary pressures.
So, Toril, where exactly does the IEA stand on releasing these strategic stockpiles?
So, as I said, now from March to September, IEA member countries have released more than 200 million barrels of government stocks. Those stock releases are still ongoing, and in October, November, there is more oil that will be released from strategic reserves of member countries. Going forward, of course, the IEA member countries still have emergency reserves that they can use in case the market tightens too sharply, but we're still completing the stock releases that were agreed in March and April of this year.
Talk to me a little bit about China. So we know that, or according to your report, it's heading for its first annual demand drop since 1990. How big a deal is this?
It's a very big deal. China has been driving oil demand growth for the past decade. And this year, we're seeing Chinese oil demand declining by about 600,000 barrels a day. In August, Chinese demand was 1.3 million barrels a day below last year's level, which is obviously a big deal. Now we're seeing that the government is still fighting to control the spread of COVID. New restrictions are put in place, which has led us to reduce our expectations for Chinese oil demand for the rest of this year and into 2023 as we see this policy impacting demand going forward.
Toril, how worried are you, if we take a step back, how worried are you about the next 6 months, the volatility and everything that could ensue if there's not a reversal?
No, of course, as we say, it comes at the bad time for energy markets. We're in the middle of an energy crisis. It's not just oil markets, but gas market, electricity markets. We are just weeks away or months away from the embargo, EU embargo on Russian oil that comes into effect for crude oil in December and products in February. And how that would play out, how Russian oil production will respond and exports will be allocated. It could have a significant tightening of the market, but we yet to see how that will play out. EU countries have reduced their purchases of Russian oil, but they still import more than 2 million barrels a day, 2.5 around, that they would have to replace by other sources. So this is still something that is in progress, and we will have to see how that works out. So there could indeed be a tightening of the market as we move forward.
Toril, as we look at possible blackouts in Europe, as you know, we try and understand really day in, day out, hourly, the situation with Russia, what should you be looking for in terms of signs maybe of easing of this energy sector, or is there really no chance of that?
So what we're seeing with Russia, of course, there has been a big reallocation of trade from into Europe, the US, Western country to the East. Now, in September, we saw actually Russia shipping more oil to East than they were to Europe and the West for the first time. But we think that this reallocation will be complicated also as the EU ban on maritime services comes into effect by the end of the year. So this is where we still have to see how the trade flows will reallocate and what the real impact will be on Russian supply and on global energy markets.
There was also this, you know, frankly strange story. Vladimir Putin saying that all infrastructure is at risk after the Nord Stream hit. Is this a veiled threat to the whole world? How do you interpret this?
It's obviously a big concern. I mean, we're seeing the Nord Stream pipeline infrastructure. We're seeing activity in the North Sea. Obviously, oil producers and gas producers are worried. Infrastructure security is part of the bigger security threats that we see in energy markets today, and it's something that we're watching very closely.
Toril, thank you so much. Toril Bosoni there, head of the IEA's oil market division, joining us this morning on the back of this very important report. Now, coming up, Chancellor Kwasi Kwarteng says the responsibility for any market turmoil after BOE bond buying ends is a matter for the governor. More on the UK next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the UK is in crisis mode. The Chancellor, Kwasi Kwarteng, says the Bank of England would be responsible for any market volatility after its bond buying program ends tomorrow. Speaking on the sidelines of the IMF's annual meeting, the Chancellor told Sky News that any turmoil is, quote, a matter for the governor. Now, for more on what's more, the Prime Minister, Liz Truss, insists that she will not cut spending or make any further U-turns on her tax cuts. Now, we're joined by William de Vilder. He's chief economist at BNP Paribas, and Christina Aquino from our markets team. Christine, first of all, the markets are worried about the inflation report from the U.S. and what that means for the Fed. But there's also a spillover effect of what we're seeing in the UK to the rest of world bonds.
Absolutely, Francine. I mean, the world is really watching the UK in terms of how it's handling this latest crisis, and it's not doing great in terms of that global impression. I mean, just earlier this week, the IMF chief economist singled out the UK as a country that's showing other global economies how not to handle a fiscal and monetary policy kerfuffle, as it were. And, you know, this latest line from Kwasi Kwarteng really is not calming markets necessarily. I mean, investors really want to have faith in their institutions, want to know that they have their backing if things go awry. But this latest line from Kwasi Kwarteng, especially ahead of that BOE pulling back from the market tomorrow deadline, is not calming nerves at the moment.
So, William, what's your take on all of this? I don't know whether this is a very dangerous game that really goes to the credibility of the UK, and whether this will take months to play out to regain that market credibility.
Well, credibility lost, it takes a long time to gain it back. That is what we all know. I think what are the takeaways from the developments in the UK? First of all, I was impressed and surprised by the extent of the global spillovers, that the jumping gilt yields were pulling along to such a degree yields on the European euro area, but including treasury yields. The second point is that clearly from a policy perspective, we need to have a proper coordination between fiscal policy, monetary policy, and macroprudential. Macroprudential means that we need to have a clear picture of where is the leverage in the system. And then fiscal, of course, well, if you're trying to slow down the economy with monetary, you should not inject more money by expansionary fiscal policy. So that is, I think, where we really have an issue. And the third point, and that is also an element of concern for the longer run, is that pension funds play a key role in financing the economy. But that goes beyond the UK, it's really the global economy. Yeah. So if you have disruption happening there because of the LDI and all the like, we still fail to come to grips with what could be the longer-term consequences for financing certain assets.
But William, talk to me a little bit. So where does the credibility issue actually come from? Is it what the government is trying to push, or is it the fact that it does seem like it's a fight between two arms which work together? Well, it's better when they work together, which is, the governor and, of course, Treasury.
Well, I think we should be more open about the necessity to have a better coordination. We have already seen that during QE. Back then, it would have been better to have a fiscal expansion supporting the zero interest rate policy or even negative interest rate policy. But it goes in both ways. When you have a contraction of monetary policy, then fiscal should also pay more attention. You don't do that, you end up having a problem, in particular when you have no visibility at all whether the longer-term debt sustainability aspects are taken into account in the fiscal policy stance that is being adopted. In addition, you have the problem that if you have a current account deficit, the rest of the world is looking at this with increasingly, I would say, suspicion, hence the knock-on effects that we have seen. So I think the coordination, yes, but also, was there enough discussion ahead of these announcements? I have doubt on that.
What's your take on, when you look at some of the pension funds and some of the questions that we have there on how they can also fund themselves, corporates may be asking the pension funds to fill the gap until we understand the liquidity measures. Like, is this a template for the rest of the world? Is it just, chaos and messy for the UK, Christine?
Well, Francine, I think, yeah, again, the world is watching in terms of how the UK is handling this. And it's very interesting. I think at this particular juncture, there are definitely a lot of questions being asked about overall pension reform. Is it time to finally look at the LDI strategy and really scrutinize it for all the risks that were apparently hidden all this time and didn't really come to light until we saw this acute stress in the bond market? And so, I think there's definitely talk of more regulation going forward. How can pension funds really diversify the types of assets that they hold at this moment so that they can have that broader base for collateral options should we see this situation again? The problem with those sorts of ideas is that it is, in the longer term, a good thing probably, but in the shorter term, you can imagine something like that, pension funds kind of changing the composition of their holdings would probably cause more ructions in the bond market.
Great. Thank you both for joining us. William de Wilder, there, Chief Economist at BNP Paribas, and Christina Kino from our markets team joining us. Now, coming up, should we be concerned about COVID cases creeping higher as we head into winter? We discuss all of that with the co-founder of Moderna, Noubar Afeyan. That's coming up shortly, and this is Bloomberg.
Let's get the Bloomberg First Word News, and I'm Leanne Gerrans. The head of the IMF says Ukraine will need at least $3 billion a month next year to finance its wartime economy, which means allies will have to give more support. At a meeting in Washington, Kristalina Georgieva also warned developments in the war could push financing needs even higher. American conspiracy theorist Alex Jones has been ordered to pay almost $1 billion in damages after repeatedly claiming that the 2012 Sandy Hook school shooting was a hoax. The Connecticut trial was the second to hold Jones financially accountable for his lies about the massacre. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Now coming up, will winter see a resurgence of COVID cases? We'll discuss the latest on vaccines and the wider backdrop for biotech with a co-founder of Moderna. That next, and this is Bloomberg.
Blame game. UK Chancellor Kwasi Kwarteng says the BOE will be responsible if markets tank after its bond buying program ends. All eyes on CPI. Stocks fluctuate ahead of today's critical U.S. inflation print. Fed minutes show a commitment to restrictive rate hikes. Plus, the IEA warns that OPEC production cuts could fuel inflation and tip the world into a recession. Well, good morning, everyone. Welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, COVID vaccine maker Moderna rose the most in 2 months yesterday after Merck extended a partnership to try and develop a cancer vaccine. The vaccine is currently in mid-stage testing as a treatment for high-risk melanoma skin cancer. Now, like many of the COVID vaccine makers, it's been a tough year for Moderna. Before yesterday's announcements, it had lost more than half of its market value this year, but if you look at it on the longer term, it's still up. So we're now joined by Noubar Afeyan, co-founder and chairman of Moderna and chief executive and founder of Flagship Pioneering. Noubar, always great to speak to you. I mean, we want to talk about the share price, but I really want to understand your world in terms of trends. First of all, you're here, and we heard from the World Health Organization that there's a resurgence that's happening, especially in Europe, when it comes to COVID. How should we deal with COVID now?
I think we have to stay vigilant, as we've been over the last 2 years, and I think we have to use the technologies that have been developed to protect us, which in this case is the new family of bivalent vaccines.
Yeah.
These vaccines are both protective against the new strains as well as the original strain, because we don't exactly know where the virus is headed as it mutates to fight our immune system, and our immune system has to essentially mutate through technology to fight the virus. And that fight is going on. I know that some would love to believe that the pandemic is over, but as the saying goes, at least, you know, we may be done with the pandemic, but the pandemic doesn't seem to be done with us. And so we just have to stay vigilant.
So when you look at some of the bivalent, right, which I'm glad you pronounced it because I always get it wrong, when can you actually provide some of the efficacy data of how it works?
We have the bivalent vaccine that is being provided in Europe and in the UK is actually one for which we have human data, and we've provided it, and it's against one of the Omicron strains. A different strain, bivalent, that has been introduced in the US is being basically tested in the market right now because it's already available. So we are measuring vaccine efficacy, and we'll have additional data forthcoming. The reality is that no matter where we've looked in these, in humans as well as in animal trials, we've seen the kind of efficacy that one needs to be able to be protected. So I think data will come along, but definitely in field use, certainly in the strain that's in the version that's here, we have human data showing efficacy already.
If you look at the US, why was there a very slow rollout of the boosters?
I think there was a slow regulatory final approval in that they wanted a particular strain in the actual vaccine, so that delayed us a little bit. And then I think the uptake is a function of education, promotion, and, you know, people are getting mixed signals. I mean, it was bad enough that people were spreading misinformation. Now they're getting confused about whether they really need it. And I think what you're seeing in the last few days is an intensified message that, you know, people are dying as a result of not being protected. There's no question we're having 300-400 deaths a day in the US. That is not an acceptable level to coexist with. And so I think we have to do a much better job.
But there are more people, and actually certainly in the summer, a lot of people people had COVID badly or not so badly, and so think they're protected for a long time. It's difficult. Like if somebody came up to you and said, "Look, do I need a fourth booster?" Does it depend on the age? I don't know whether it's misinformation or really vaccine fatigue out there.
I mean, I don't know. I mean, look, I don't want to seem kind of tough-minded about this, but I don't know what vaccine fatigue means any more than I know what cancer fatigue means or I know what hypertension fatigue means. It's your health. And at the end of the day, frankly, even beyond your wealth or your happiness, your health is the thing that needs protection, active, proactive protection, and that's what a vaccine does. So the notion that we should allow ourselves to get tired of protecting our health is something that I think one does by taking unnecessary risk. You could also cross the street, during ongoing traffic and say, you know what, I'm tired of waiting for these cars. Yeah. And so I just think there's a correspondence that we're missing. Somehow we're putting vaccines in a different category, and they're not. They're just a way to protect your own health. It's your own decision. But overall, the data suggests that it is much better to be protected than not.
But is that because people still get sick? So where does this, I don't know if you call it a schism, but if people don't want to get the third, fourth booster, is it because they think they'll get sick anyway and they were expecting the vaccine to do something else?
I think that it's important for people to understand that our immune system is what is the medicine here. The vaccine simply directs the immune system to do what it can do. The immune system, first of all, protects us against infection, and then once infected, it becomes therapeutic in that it actually goes after the virus and eliminates it. The therapeutic side of this, there's no evidence of that waning, and our bodies are very good at fighting back once it gets in. The vaccine helps you put off or reduce the chance of getting infected. It does not eliminate it. So with a vaccine, you're going to have a lower chance of getting infected, and in any event, you're going to have a primed response once you get infected. Without a vaccine, you have a much higher rate of getting infected, and then once you're infected, your immune system is going to be relatively slow to respond. I think that's the kind of contrast, and between those two, the first option seems to be more protective overall.
So are people willing to get boosters more here in Europe and certainly in the UK than in the US?
It seems that the level of trust between the people and their healthcare providers, particularly with a central NHS here and elsewhere, is much higher in Europe than it is in the US. I think in the US we have kind of a confused state right now. There's depending on your zip code, depending on your education level, depending on your political party, which is remarkable affiliation, people are and are not choosing to get vaccinated. Look, this is a bit of an opportunity for the virus to find laboratories in which it can mutate, namely people who are not well protected. And so the fight is dragging on somewhat because people are making these choices, which is further allowing the virus to mutate. The virus has more mutants available now in people's bodies than it did previously because it's proliferating. Not just because sometimes we think mutating means you go from A to B. There's A to 50,000 letters now out there. I mean, it's just proliferating, and our immune system is going to have a harder and harder time if there's ample places for it to keep mutating.
But the more we vaccinate, does it change those mutations or no?
The more we vaccinate, the more our immune system goes after one aspect of the virus, then other places become vulnerabilities. So the virus is trying to escape wherever there's pressure. But in some places where there isn't kind of enough pressure, the virus can replicate before it has to be fighting the immune system. So it's if I said from 2 years ago, this is a battle between a life form that is preying on our social behavior and contact and our immune system, which is designed to fight back, but is struggling because the virus is really mutating very quickly.
Nubor, yesterday, so there was really encouraging news about cancer vaccines. Broadly, what's your approach to those and how they'll change?
Yeah. In fact, cancer vaccines are programs that we've been working on for 5-6 years, and cancer takes quite a long time. But interestingly and coincidentally, that we had worked on cancer vaccines is why we could respond so quickly to go after the virus, the COVID. And the reason is that a cancer vaccine is doing a similar thing, which is it's telling your immune system to fight a certain number of new sequences in your body, namely a cancer sequence instead of a virus. So that program has been ongoing for a while, and it's been gradually collecting data. What we announced yesterday is that through our partnership with Merck, which obviously is a very large pharmaceutical company and very accomplished both in cancer and in vaccines, that they chose to expand and enlarge their collaboration on this program. And so it's very exciting to see that.
But this would be an incremental benefit of being vaccinated on top of the old school therapeutics to fight cancer.
Right. So let me clarify that in the case of cancer, we're talking about a therapeutic vaccine.
Yeah.
Remember I said in COVID, there's a preventative and a therapeutic version?
Yeah.
Well, in this case, you're using the therapeutic because you already have the cancer. And so the way that works is that you're showing all the different sequence variants to the immune system that your cancer represents, and the immune system is much better armed to go after it. So it's using vaccination as a therapeutic, not as a preventative.
All right, Nubar, thank you so much. We'll continue that conversation and talk a lot more about some of these cancer vaccines. In the meantime, we need to look at banks. Actually, Bloomberg story, or just crossing Bloomberg terminal, is Monte Paschi, the world's oldest bank, halted limit down after falling more than 13%. Now, I think they've always been quite thin on volumes, but it's falling after setting some of the terms of a capital hike at a discount. I know there was so much speculation over the last 2 or 3 years about who would buy the bank if anybody wanted the bank. We also know that there was political pressure from the Italian government for one of the big banks to absorb this. Did this not happen? Liquidity and again, trading is quite volatile on Monte Paschi, limit down 13%. Now, more coming up with Noubar Afeyan, the co-founder and chairman of Moderna. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. ASML has ordered its US staff to stop servicing customers in China after the Biden administration announced tighter restrictions. The Dutch chip manufacturing equipment maker told its employees in America about the rule changes in an email. ASML has held back from selling some of its most advanced technology to China as it tries to strike a balance between the two nations. Now, the US is considering a total ban on Russian aluminium in response to the military escalation in Ukraine. Bloomberg has learned that the Biden administration is weighing a number of options, including an outright ban or a large increase in tariffs. Russia is second only to China as a producer of aluminium, which is crucial to most heavy industries. And Hong Kong is said to be considering easing property taxes and visa restrictions as authorities seek to curb the pandemic brain drain of recent years. Bloomberg has learned Chief Executive John Lee could include the measures in his first policy address happening later this month. Hong Kong's strict pandemic measures have seen it lose ground to Singapore as an international financial hub. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now let's go back to vaccines and Moderna. We're joined by Noubar Afeyan, co-founder and chairman of Moderna, and the chief executive officer and founder of Flagship Pioneering. Noubar, thank you so much for sticking around. We were talking a little bit before about vaccines, the uptake of boosters, also the resurgence of course, COVID in the winter months. Talk to me about long COVID. So what do we know concretely? Because again, there's pockets here and there of data that the media exemplifies. What do we know about long COVID and the link to vaccines?
We are learning about long COVID, and everything we're learning is actually quite concerning, and that is that there's a persistent effect of getting COVID infection. It's not clear whether mild or strong versions of it are more correlated with it, but clearly in a significant percentage of people, some people say up to 10%, there is a persistent 6, 12 month, even beyond, fairly debilitating effect. And it happens to be in many different organs in the body. It's in the brain, it's in the liver, it's in the heart, and it's manifesting all over. Some people are now beginning to claim that that's because some amount pockets of virus are persisting. All of that is a consequence of not having an adequate immune response to get rid of the virus, which is enhanced by vaccines. So our sense is that the less people get infected, the less you're going to have long COVID. And in any case, if you can tame that infection by a strong, kind of an effective immune response, then you're going to try to reduce that risk. But we need to spend a lot of money understanding this disease, because now the virus is kind of becoming a double punch. One, through infecting you, and the second, through having a long-term effect.
But so the long COVID, are the numbers going down in long COVID in terms of percentage of when people catch COVID because of the vaccines, or no?
I don't think we know yet. I think the numbers, because we don't have a good way to diagnose it, it's a fairly loose diagnosis because people are suddenly being sick and being debilitated. So I think that we're going to learn more.
Are you talking to China about bringing a vaccine over there? We know some of your rivals have actually partners on the ground. Are you doing the same?
We have had discussions with China, and that will continue. We're prepared to support the country's fight against COVID. Obviously, as a global company, we want to make sure that's done respecting intellectual property, respecting the kind of distribution arrangements that we have, and we look forward to making that happen whenever it makes sense for them.
Which could be?
I can't forecast it because I think it's a complicated issue. Obviously, every country wants to make their own versions of vaccines, and they have internal competition as well as wanting to access external products. So I think these are complex decisions they need to make.
You have a sizable exposure here to the UK. We've seen a lot of volatility in markets, a lot of questions about the government's plans, about liquidity, even corporation tax. What's your take on the UK? Is it investable right now?
I think it's investable, particularly in the life sciences. I mean, we're very excited about the prospects of the partnership between the UK and Moderna in the first instance, which should be a rather transformative presence of a company with significant investments in clinical research here that we've committed, as well as manufacturing of vaccines. But beyond that, we're seeing several of our other companies within the flagship ecosystem do clinical trials here. And what we're finding on the heels of that is a general facility to do this here, a regulatory entity in MHRA that seems to be very, very forward-looking and very collaborative. The NHS, which is a single provider, is a good partner to interact with. The scientific community, whether it's in the major universities or all over the country, there is a general potential here that we perceive that is quite unique and very timely.
Does it mean that you'll put more money in the UK, and could you even buy other companies, or certainly buy talent, given the market turmoil?
We are, Flagship's based in Boston, US. I'm here for the second time over the last 6 months, largely exploring whether there are opportunities here that might lend themselves to a stronger presence, whether it's investment or collaborations or creating companies. All of that is what Flagship does, the parent company here, and all of that, we think there may be opportunities here. So we're very interested in exploring and finding the right way of doing it.
Does it matter to you if corporation taxes go up or down in the UK? I mean, some argue that actually if you're a chief executive and corporation tax goes up, at least it brings a bit of stability. Others saying, well, it's just a tax on profits.
Our companies are research companies primarily, and so it takes a while for them to get to a place where they're actually thinking about corporate tax. It's one of the oddities of biotech companies is that they're primarily invested in making asset value through intellectual property and research. And so I've been less focused on that part of it any more than in the US. That doesn't really affect how we behave. More generally in other industries, I'm sure that's a major driver. But for us, we've been rather focused on human capital, scientific capital, and financial capital, and how to unlock it in the UK as it relates to the biotech sector, in which it's been very modestly involved so far. So I think there's a lot of growth here to do.
Does inflation impact you?
Inflation will impact us in many ways, but no, not uniquely compared to other industries. The supplies that we use to make our products are relatively kind of minor part of the value that we're creating. A lot of the value is the ultimate impact as opposed to the cost of goods. So yes, it matters. Of course, the cost of living matters. Inflation affecting that makes people less comfortable. And so that affects us, but not, again, specific to the biotech. It's a very unique research, science-based value creation sector, and so people have to think of it in that way versus one of many equivalent sectors.
Nuber, I think we started the interview also, mentioning your share price. Do you look at your share price? Are you expecting it? I mean, do you just focus on growing the company, or do you worry about the fact that over the last 12 months it hasn't been performing, I'm sure, as well as you wanted it to?
I think, I've been at this for 35 years as an entrepreneur and an executive, and in this case, chairman of Moderna. And during that time in biotech, I've seen share prices at the same time reflect the current reality, but once in a while reflect the future potential. And that defines the difference between 1 and 2 or 10x. In other words, as people start looking forward, they start realizing what the value could be, and the price starts reflecting the future as opposed to the present. Right now, I think a lot of stock prices, not ours only, reflect current concerns with inflation and uncertainty and wars and et cetera. And all of that is understandable. But at some point that settles out and people start saying, okay, of the remaining companies, which ones have high prospects? I think that Moderna and others that are really pioneering in new spaces will be rewarded, and shareholders will be rewarded. So at any given time, yes, I look at it, but I look at it to contextualize what it is reflecting as opposed to what the actual number is.
Nuber, thank you so much for coming in the studio today. Nuber Afeyan, the co-founder and chairman of Moderna and chief executive and founder of Flagship Pioneering. Now, we'll continue, of course, to keep you up to date, also with market news, today's key data, US CPI, and how it could impact the Fed's next move. That's coming up shortly, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Saba Capital Management founder Boaz Weinstein says the uncertainty that's currently gripping markets could endure for a long period. The hedge fund manager spoke to Bloomberg's Barry Ritholtz in an exclusive interview.
I'm used to, and we're all used to, sell-offs that are fairly quick, that we know. Even 08 was 5 or 6 months from Lehman to the lows of March 09, where at the end of it, you can kind of wonder, is there an all-clear sign? We have the Fed behind us, quantitative easing. Now we don't really know who the savior is, because at the end of all of this, we're still going to have quantitative tightening and shrinking the balance sheet. And so whereas a lot of sell-offs were just a prelude to a bull market 1 or 6 months later, this has the feeling to me like we're going to be worried about some number of these things or new things for potentially quarters and maybe even years to come.
So no capitulation yet, no flush, which gives us that all clear signal. How much of that is based on truly not knowing what the Fed's going to do, or is it we don't know which potential problem is real and which is fake news?
These things are so hard to predict. I even want to be cautious about opining too much, because it's just such a confusing market, and there hasn't been a single thing to say, okay, this is why why 20% is not enough. It should be 40. Let's take inflation. If you look at forward inflation, it's expected to come down a lot. So you could look at tomorrow's CPI print, if it comes in a tenth or below or high, and get excited about it. But the market is still telling you inflation is not going to be the problem that it is 1 year from now. Now, if a few months from now that conviction is shaken, then we're going to have a real strong sell-off. If somehow Russia, heaven forbid, becomes more asymmetric, we're going to have a real problem. And so we just don't know. We're in a fog, and we should not rely on the lessons that people learned maybe incorrectly for this environment that were good between 08 and 2022, which was the Fed is your put, don't fight the Fed, and dips should all be bought, and being short is fighting the Fed. This really does not feel like that environment, in particular because of where the central banks are versus then.
Well, that was Saba Capital Management founder Boaz Weinstein. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York, Anna Edwards in London, and this is Bloomberg.
You're having all these problems in other parts of the world. So the pressure is going to mount on the Fed.
Anybody paying attention cannot deny that we now have a set of circumstances that clearly point to a recession.
You need, hopefully, some continued signs that inflation is easing. All the inflation lead indicators are easing, but the headline inflation numbers are not.
Things can change very quickly. We've seen that. That's been the typical pattern.
Stop trying to pick this bottom. Stop trying to look for that pivot.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. Taming inflation. Investors await U.S. consumer price figures today that may determine if the Fed will deliver a fourth outsized rate hike. Downing Street is playing the blame game. Kwasi Kwarteng says the Bank of England will have to answer for any market turmoil that might erupt when the central bank ends its bond buying program tomorrow. And as the IEA warns that OPEC Plus cuts may tip the global economy into recession, US officials fear their Russian oil price cap plan may fail. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, we've been on gilt watch, it seems, for days and days now. We go to inflation watch stateside today.
Yep, that crucial CPI data is due in just about 3.5 hours' time, Anna, and it's going to be a big one for a lot of different reasons. Of course, you had to trade in Asia before you got those figures, but by and large, it was a down day overall. The MSCI Asia Pacific Index down by about 1%. Hong Kong, a real underperformer. Hong Kong stocks actually falling to their lowest level since 2011, and the drag created by tech stocks in particular had a lot to do with that. The Hang Seng Tech Index down about 3.4% overnight. Of course, a lot of that has to do with weakness in the semiconductor space. It's just warning after warning on demand. Plus, you have the new Biden administration curbs as it relates to Chinese chip companies. And overnight, Taiwan Semiconductor said it's cutting its capital expenditure target for the year by 10%. So just another warning sign for the sector. And TSMC down for a fourth day in a row overnight. Now its losses over those 4 days at about 12%. Finally, in foreign exchange, just wanted to point out that the dollar is fractionally weaker against the Japanese yen. Really one of the few exceptions out there today. But at 146.83, we are still at levels on dollar yen that we need to watch for fresh intervention from policymakers, because around this level is when Japan policymakers stepped in last go around to stem the weakness in the yuan, and of course, or the yen, excuse me. And remember, Matt, last CPI day, the yen moved about 2% weaker against the dollar within minutes. So that's going to be a currency pair to watch when that data drops at 8:30 a.m.
Yeah, absolutely have that up on my dashboard, Kailey. I'm looking at futures that are a little bit higher today after the drops that we saw in the cash trade yesterday. We got down to 35.77. However, extremely light volume yesterday, today as well. You're going to see very light volume, or at least in futures, until the CPI print comes out. Traders are going to want to sit on their hands. The 10-year yield hovering right around where it was yesterday, 391.08 right now is the level there. This is poised also, obviously, to snap in one direction or the other, depending on what we see in terms of the CPI number. NYMEX crude coming up 59 cents to 87.86. The Saudis coming out and defending themselves against President Biden's criticism, saying they have noble ambitions to balance the oil market. And right now we're looking at Bitcoin that's off just about 0.8%. Still hovering at that 19,000. I think I am going to sideline Bitcoin in my board for a few weeks until it at least moves out of the $19,000 to $20,000 range. Anna, what are you seeing in Europe?
Matt, let's have a look at where we are on the European picture. And things looking a little brighter than they did at the start of the trading day. We were pretty negative as we started out, but recovering a little bit of poise here. The CAC 40, the Xetra DAX, both up marginally. There's been a lot of focus on UK assets, UK gilts in particular in recent days. So let's get quickly to that. Of course, we are all focused on the US inflation data later on, of course. But here's the 30-year yield, and it's coming down. The 2-year yield coming down. So we've got yields coming down across the gilt curve, which is obviously a positive for global risk sentiment when we've been watching those yields climb, despite what the Bank of England has been doing. And thinking of the Bank of England, they seem to be under pressure from various market voices saying, well, maybe they'll U-turn. The Bank of England says it won't. The government in the UK under pressure. Lots of voices, even within the Conservative Party, saying maybe there'll be a U-turn. They keep saying that they won't. We'll see how this plays out tomorrow, the weekend, Monday. Brent crude, Matt's talked about what's going on with oil. We are up by 0.7%. It seems the IEA taking a almost similar view to the White House, suggesting that this cut in production we've seen from OPEC+, that is going to be something that risks pushing up oil prices, and that could weigh on the economy to the extent of causing a recession in their view. ASM International in focus. This is a part of the chips universe, of course, and the company under pressure. We heard from, of course, a player in the United States in this space. They were talking about sales being under pressure. We heard from TSMC over in Taiwan. They talked about paring back CapEx expectations. So pressures on the chip sector, it seems. Matt.
All right, so we're focused on the inflation data that we're going to get out today. It may keep the Fed on path for a big November rate hike. In fact, many economists say they're going to do 75 no matter what this print is. But what comes next is maybe more important. Fed Governor Michelle Bowman says she continues to favor large increases in interest rates to cool inflation.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table. However, if inflation starts to decline, I believe a slower pace of rate increases would be appropriate.
Bloomberg's Danny Berger joins us now to preview today's key data. And Danny, how do we expect markets to react?
Well, markets feel very wound up at this moment, and surely the data we got yesterday in the PPI figures isn't really that reassuring. We had PPI rise yesterday, the first data point of rising after 2 consecutive months of falling. And to be clear, this wasn't about fuel prices, because even core PPI rose by about 0.4%. In terms of our expectations at the moment, economists surveyed by Bloomberg see core at 0.4%. It was at 0.6 last month. And there's this question of just how much lower does it need to go in order to get any sort of relief rally, in order to indicate that perhaps the Fed won't be as hawkish, considering we had those FOMC minutes where there was some indication of more folks talking about a two-way risk. But Matt, to get back to the first thing you asked me, because I should probably answer your question, yeah, markets are really, really nervous about this reading. The VIX curve, that is very inverted with a lot of volatility embedded in the front end of that curve. So for today, even Treasury volatility, that is back at the highs of the pandemic sell-off. And of course, UK bond volatility, that's contributed to this. But a day where we're getting CPI and volatility plumbing new highs for the year, it certainly feels like a nervous setup, Anna.
Yeah, it does feel like a nervous setup. And just as you were talking there, Danny, in terms of thinking about what's going on the gilt market, I mentioned it when I was talking about gilts a moment ago. The UK long bond surging, 30-year yields down 21 basis points to 4.61%. That was one of the yields we were watching go over 5 yesterday, and very much in focus as the Bank of England has today and tomorrow to do those operations. Thanks very much to Danny Berger. Let's think about how the UK is progressing here. That's what's going on in markets. The UK Chancellor, Kwasi Kwarteng, says the Bank of England will be responsible if UK markets suffer renewed volatility after its bond buying programme ends tomorrow. Bloomberg's Lizzie Burden joins us now from the Bank of England. Lizzie, it seems the Chancellor and the Governor, they're kind of playing a game of chicken, a bit of a standoff as to who's going to give any ground by the weekend.
Yeah, I know who's going to blink first. If it's Andrew Bailey, if he gives in and extends the emergency bond buying programme, rows back on his tough talk from earlier in the week when he said it was going to end tomorrow, we have to ask how much it will undermine his credibility on the monetary policy front. Will markets believe what he says he's going to do when it comes to fighting inflation? And on top of that, if the Bank of England continues buying bonds, it can't go on with quantitative tightening, at least for now, which would mean that it's prioritising financial stability over inflation fighting. And that's exactly what the chief economist, Hugh Pill, said this week the bank does not want to do. So how do we get out of this? Well, fiscally, Liz Truss has said she's not going to cut spending, which means that she would have to U-turn on tax cuts if she wants to balance the books and try to regain some market credibility. And on the Bank of England side, the only hope could be a creative solution from the Debt Management Office, which is part of the Treasury, when it comes to raising short-dated money to ease pressure on longer-term debt. This is a suggestion from strategists at HSBC. But the irony really is the Truss government throughout the summer criticised the Bank of England for not doing enough to fight inflation. Then she said that the Bank of England's independence was sacrosanct. And now the Bank of England can't do its job fighting inflation properly because it's having to put out the fire that the fiscal policy started.
All right, Bloomberg's Lizzie Burden. Thank you so much. Our wonderful markets producer, Dan Curtis, just pointing out that we have seen a 20-plus basis point move on the 30-year gilt yield in 6 of the past 15 trading days. Absolutely remarkable in the bond market. Let's turn to the commodity market now, though. The U.S. is proceeding with its plan to cap the price of oil from Russia. But some Biden administration officials are growing concerned that the plan may backfire after the OPEC Plus alliance's surprise production cut last week. That's according to people familiar with the matter. Meanwhile, Saudi Arabia rejected criticism of the cut, saying the move was based solely on its noble objectives to avoid oil market volatility. Eddie Vanderwalt of Bloomberg Markets Live joins us now for more. And Eddie, in addition to that, you have the IEA warning that the cut from OPEC Plus could put prices at a level which leads to a global recession. What is that level, and how likely is it that oil gets there, given all of these different forces at play?
Oh, wow, absolutely. You know what? I think there's so much at play in the oil market. I think, OPEC has signaled that it's quite comfortable with prices for Brent around about the $100 a barrel level, and we're a little bit below that at the moment. But, whether the world economy can sustain prices at that level, that's quite another matter. And I think what this really has told us, though, the wrangling over the oil market, is that supplies are quite tight. And I think if we see demand picking up, oil could shoot significantly higher because there doesn't seem to be that much spare capacity in OPEC. And I think the US position is making clear that this is becoming an election issue for Biden. So I think there's, the oil market's going to be at the center of conversation in the next few months.
Yeah, absolutely, politically and economically. Eddie, thank you very much. Eddie van der Welt of Bloomberg Markets Live. Elsewhere in commodities, we should bring you up to date with what is happening. The US is considering a total ban on Russian aluminium in response to the military escalation in Ukraine. Aluminum surged after Bloomberg reported the Biden administration is weighing a number of options, including an outright ban or a large increase in tariffs. Russia is second only to China as a producer of the metal, which is crucial to most heavy industries. Matt?
Yeah, we'll be paying very close attention to that. We are watching, of course, what's going on in Brussels, where NATO defense chiefs are gathering for a second day of meetings today. They will discuss increased security of critical infrastructure and are expected to offer more air defense capabilities for Ukraine in the face of Ukraine's stepped-up missile strikes. Bloomberg's Maria Tadeo joins us now with the latest. So, Maria, what do we know?
Yes, Matt, and the message from the NATO Secretary General this morning is that the alliance will stand by Ukraine, quote, for as long as it takes. It will increase support for the country and provide the air defense systems. Remember, this was the main ask from the Ukrainians going into this meeting. Of course, the question always when it comes to NATO is who provides who, but also just how quickly can this get to the front line. The other big issue, which to me I'd argue is equally important for some European countries as part of NATO, is what happens to some of the critical infrastructure, so the pipelines, the cables, the underwater systems, the grid, that they worry could be compromised in a form of hybrid war going into the winter. Well, the NATO Secretary General says if it is maliciously compromised, it will trigger a, quote, united and determined response from the alliance. Now, the question, and this is key, is could it trigger Article 5? There's some strategic ambiguity from NATO this morning.
All right, Bloomberg's Maria Tadeo reporting from Brussels. Thank you so much. Now let's get back to the equity market and take a look at some stocks moving in pre-market trading here in the U.S. Anna was just running us through what's going on with aluminum prices, and that is having a positive read-through to aluminum makers here in the U.S. like Alcoa. The stock was up about 5% yesterday on that original news around the Biden administration weighing those moves, and just a little bit more of a gain coming this morning, up about 0.4%. Another stock that is gaining is Delta Airlines. This is interesting because it does report this morning. It just hasn't reported yet. And yet ahead of those results, the stock is up 2.6%. Maybe traders have a little bit of confidence after the positive pre-report we got from American Airlines earlier this week. So look out for those figures in just a couple of hours. But two stocks moving to the downside would be U.S. casino operators that have big revenue weighting toward Macau in particular. There is concern around the COVID-0 strategy in China persisting even after the Party Congress wraps up in a week or so. So you have Las Vegas Sands starting to gain a little more traction in the pre-market, but down hard for Wynn Resorts, down about 2% before the bell, Anna.
Yeah, Kailey, maybe we'll get to focus more on China tomorrow as we work our way towards those important meetings taking place, and they start this weekend. Coming up on the programme, we'll speak to Charlotte Ryland, co-head of investments at CCLA Investment Management. We'll get her perspective on what's going on with UK gilts. I feel I've said whipsaw too many times this week. Very much overused, but very much appropriate as well as we watch the 30-year yield really dropping today. We'll also talk US CPI with Charlotte and with Steve Blitz, TS Lombard, chief US economist. We'll get his perspective on exactly what to watch for. Plus, down to the wire, the fate of the Democrats' agenda comes down to a handful of key U.S. Senate races. Today's Big Take explores 3 plausible outcomes. Read more on Bloomberg.com or on the Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now, I'm showing a chart. For those of you listening on radio, normally this would be a big move for a year or even multiple years, but it's less than a month. This is UK gilts. These are the long 30-year gilts, and we've gone from 360 basically to 500 in less than a month. Today we've gone down another 20 basis points in yield, and each day we're up or down 20 or more basis points. It's pretty insane. Joining us right now is Simon White, Bloomberg macro strategist out of London. Simon, what do you make of this incredible volatility? It's not just gilts, right? We've seen this in the Treasury market as well.
Yeah, I mean, liquidity across bond markets is kind of fallen through the floor. The Treasury market, supposed to be the most liquid market in the world, has very low liquidity right now. And obviously the UK situation is kind of even more extreme. So the moves you're getting in UK gilts are they're big moves, and they obviously have their own kind of unique problems in the UK, but really this is something that's more kind of broadly systemic, I think, in the current environment.
Simon, good morning. And what had been broadly systemic had been rate rises. Today we see gilts, the yield on gilts coming down across the curve, a little bit less tension in the markets for some reason. What are we watching for in the tenders that take place with the Bank of England today and tomorrow? They did more yesterday than they've done at any point during this special provision that they're doing for the pension sector. They did more yesterday than at any time, but they haven't got to the maximum that they can do in a day. What do we watch for here?
Well, I think they've laid the gauntlet. I mean, this is very interesting because it's the first time really in a long time we've had the central bank pushing back against the market. For many, many years, the market's kind of got used to kind of throwing its toys out the pram and it getting what it wants. Central banks having bigger kind of facilities and easing and lowering rates and all the rest of it. This is really the first time I can remember where the central bank has pushed back. So, if the LDI funds can get what they need to get done by Friday, and we get into next week and there's been no major volatility, and I think that's quite interesting.
And it's hard to know, isn't it, whether they can, because I was talking to one of our colleagues earlier who's saying there's just so much leverage and nobody really knows how much.
Nobody really knows, but on the other hand, that some of these, the people that are running these funds must have some idea what they need to do.
Yeah, they do, yes. Kailey?
Well, Simon, speaking of central banks and markets being in contention, the Federal Reserve continues to say don't bet on hikes cuts in 2023. The market keeps betting on cuts in 2023. How could the CPI data today inform or change that narrative?
Yeah, I mean, the rates market is basically front-running this pivot, if you like, this sort of 2023 sort of inversion in the curve. So really the risks are the other way. So if we do get a higher print today, I think that could create some fireworks. I think 10-year yield could easily go through 4%. I think the curve will invert more. But really, the indicators are that's not going to happen. If you look at all the sort of medium-term indicators of inflation, for instance, survey expectations are falling. Margins, which have been a huge driver of this inflation that we've got, have also been falling a lot, like things like used car dealers, freight distribution, all these sort of things. So the thing to watch really is the transport component. That's been really taken a lot out of inflation over the last few months, so that should continue to do so, as long as the shelter and food components don't rise too much to mitigate that. But general trend is heading lower for now.
OK, that sounds hopeful. Simon, thank you very much. Bloomberg Simon White joining us there. And for more market analysis, check out MLIV Go. That is the function to use. If you want to find the Markets Live blog, there's plenty on there about UK gilts. There'll be plenty on there about US CPI as well. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. In Ukraine, the Kyiv region was struck by Iranian-made drones today as air raid sirens rang out across much of the country for a fourth morning. Airstrikes also continued in the south. Meanwhile, allies in Brussels for a NATO defense ministers meeting are expected to offer more air defense capabilities for Ukraine in the face of Russia's stepped-up missile strikes. Meanwhile, the head of the IMF says Ukraine will need at least $3 billion a month next year to finance its wartime economy, which means allies will have to give more support. At a meeting in Washington, Kristalina Georgieva also warned developments in the war could push financing needs even higher. And American conspiracy theorist Alex Jones has been ordered to pay almost $1 billion in damages after repeatedly claiming the 2012 Sandy Hook school shooting was a hoax. The Connecticut trial was the second to hold Jones financially accountable for his lies about the massacre. Coming up, we'll get back to the markets ahead of today's crucial CPI data coming in just about 3 hours. Charlotte Ryan, CCLA Investment Management co-head of investments, joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Taming inflation, investors await US consumer price figures today that may determine if the Fed will deliver a fourth straight outsized rate hike. Downing Street is playing the blame game. Kwasi Kwarteng says the BOE will have to answer for any market turmoil that might erupt when the central bank ends its bond buying program tomorrow. And as the IEA warns that OPEC Plus cuts may tip the global economy into recession, US officials fear their Russian oil price cap plan may fail. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And of course, Matt, we're all waiting for the CPI print later on today. Any sense that we're peaking? Any sense that rent can deliver any relief?
Yeah, absolutely. We'll be tuned in, glued to the screen for that release. Nonetheless, we don't see, or maybe because of that, we don't see a lot of action in the markets right now. Futures are up about 0.5%, but volume's very low, and volume in the cash market was very low yesterday as well. We came down to 35.77 at the close yesterday, and we could see a little bit of a bounce from that. But I think, you know, a lot of traders are still expecting 75 basis points. So the number that we get today is going to determine what happens after the November meeting. Nonetheless, you could see big gyrations in stocks, in treasuries. Right now, we're holding pretty steady at 390. It's 389.65. Even NYMEX crude really isn't moving very much. It's only up 20 cents with all the back and forth between the president, who has said there will be consequences for Saudi Arabia in terms of the production cut we got from the last OPEC meeting. Saudi Arabia responding, saying they have, you know, a noble work to do in terms of keeping the oil market balanced, and it wasn't about siding with Russia. And then not much movement in Bitcoin. Of course, there doesn't seem ever to be any movement in Bitcoin, at least the last few months. Right now, we're down just 0.8%, but still holding over the $19,000 range. And Kailey, what do you see in terms of the U.S. market?
Well, obviously, we have CPI in focus today, but we also are going to be getting some earnings this morning, including from Delta Airlines, really the first official report we'll get from the airline sector here in the U.S. And ahead of those results, the shares are higher by about 2%. There may be some positive read-through from the fact that the pre-report we got from American earlier this week was fairly strong. Elsewhere in the travel sector, though, not as much luck for Carnival Cruise Lines. It's down about 1.25% before the bell. And then two other stocks are really a sector worth mentioning this morning. Casino operators that are listed here in the U.S. but have big businesses in Macau. There is a lot of concern in Macau, not just about a weaker Golden Week holiday that just wrapped up a few days ago, but also around the COVID zero policy, perhaps persisting even after the Party Congress is over. So as a result, MGM, Wynn Resorts, each down a little more than 2% before the bell, Anna.
Kailey, European equity markets then kind of in a holding pattern, waiting for the US CPI data. We sense also waiting for the latest developments around the UK gilt story. And let's deal with both of those. So this is where we are in the holding pattern, up by just 0.25% on European stocks this morning. The 30-year yield then dropping substantially, as we've talked about a number of times already on this programme. We seem to see a bit of a standoff between the Treasury and the Bank of England, both under pressure to change course, and both of them insisting that they won't change course as we head towards the end of the bond buying programme. That comes tomorrow. We've got today and tomorrow to deal with the bond market, to deal with the long end of the gilt market. That programme from the Bank of England comes to an end tomorrow. That's what the BOE says. And so we're all going to be watching for the detail around how much of the gilt market the Bank of England is buying. They bought more than they have on any day so far in yesterday's session. Are they buying a lot today? Is that part of the reason we're seeing so much movement in the 30-year? Brent crude is up by 0.3%. The IEA giving us their view, saying that they also think that cut in production from OPEC Plus could risk pushing up oil prices and therefore weighing on the global demand story and causing a recession. And ASM International, this is a global story around chips, of course. There's been the tension between China and the United States. And then we got an update from a US player, of course, which was talking about revenue difficulties. We also heard from TSMC. They've pulled back their estimates around CapEx. So all of that, Kailey, adding up to further gloom for the chip sector.
The gloom just keeps coming. It seems like a tidal wave of bad news in that sector in particular. And frankly, it seems like a tidal wave of news always in the UK as well. So let's continue that story discussion. Joining us is Charlotte Ryan, CCLA Investment Management Co-Head of Investments. Charlotte, every day it seems there is more volatility. We have seen 6 out of 15 trading days with a move of 20-plus basis points on the 30-year gilt yield. How confident can you feel about investing in any UK asset right now?
Goodness. I mean, I think it'd be a little extreme to write off the entirety of the UK just because we're getting gyrations in the bond market. I mean, you know, clearly there's been some liquidity issues within the gilt market. There's, you know, the huge moves that we've seen in response to the mini budget have clearly caused some issues within the pension funds, and the Bank of England was trying to calm that that situation down. But I think it's, certainly the yields that we're getting to now within the UK, certainly 30-year pushing through 5%, is getting to a point where actually you think that's probably far enough. And certainly the market's pricing in, 6% as a sort of terminal interest rate in the UK, which I think is a pretty high level to be pricing in. So for the first time in probably years, actually, you're probably getting to a point where actually the bond market is looking a bit more interesting and actually showing a little bit more value.
Charlotte, I wonder, it's probably a little early to learn lessons from this, given that we're still very much, it seems, in the depths of this crisis. But we had a question in from one of our viewers, and it might be useful for international viewers to understand this, who was asking about why pension funds are allowed to run leveraged bond positions. And I know this is particularly related to defined benefit schemes or DB schemes, and it's quite complicated. We've heard from the regulator talking about how pension funds must learn lessons from this cash crunch. We also know for those schemes that higher interest rates can be positive for them longer term. It's in the short term that they have issues. I mean, where do we think we turn for insights into why we've got to this position, Charlotte?
Yeah, I think if the defined benefit schemes, which is the ones we're talking about here, are basically in runoff. That's not something which is a growing part of the pension scheme anymore. And clearly what they've been doing is trying to, put in something in place which is hedging their liabilities. And what's upset them is the fact not that the bond market yields are moving up, but that they've moved up so rapidly. And I think it's that volatility and having to cover, some of that collateral that has caused the issues. So in terms of sort of, pension funds going forward, I suppose, it's a question of making. I think the funding is still there behind them, the liquidity is still there behind them, and longer term, if you've got higher bond yields, yes, that means the liabilities are worth less, effectively. So it's a short-term issue, and hopefully something that the Bank of England can sort out.
What are the spillovers that you're concerned about here, Charlotte? Because from an international perspective, some trading desks telling Bloomberg that they've seen pressure on US corporate debt, for example. They've seen pressure on CLOs in Europe. There have been all kinds of areas that they've seen pressure and rising yields as a result of what's going on here in the UK and the spillovers into those markets. And now I was reading also on the Bloomberg, there's concern around other areas of the shadow banking system in the UK, whether that's private equity or fintech. Where do we look next for the next shoe to drop, I suppose?
Yeah, and I think that is the big question. And it isn't just a UK problem, because the direction upwards in interest rates is true in the US, it's true in Europe as well. And so we've had, an era of very cheap money. And so I'm trying to work out who is going to be most vulnerable to that. It is going to be quite hard. I think probably it isn't the banks this time, because they've been so well recapitalized after the last crisis. I think if you've got businesses which are holding a lot of leverage, where that leverage needs to be refinanced in the short term, that could be a problem. So I think you need to be sort of slightly careful in which equities you're owning, making sure that they actually have those decent balance sheets. But if, certainly in the sort of the private markets, we don't have a great deal of visibility of what's been going on there. And so, potentially that could be where some of these problems emerge, but it's very difficult from the outside to actually sort of pinpoint where.
Yeah, well, we wouldn't have known how much leverage these pension funds are holding either if we hadn't had this little hiccup here. Charlotte, it's not just about the UK, right? Yesterday, the U.S. Treasury Secretary, Janet Yellen, said, and I quote, "We are worried about a loss of adequate liquidity in the market," talking about the Treasury market. How insane is that?
I know. It's quite surprising, actually, how illiquid some of these bond markets are. And I suppose, one of the big buyers that we've had in the market for the last few years has been central banks, and they're stepping back. So, that's a concern. So, and if you move into quantitative tightening, we don't really know what the implications of that will be, because we've never really seen anybody do it before. So I think it's going to be something, again, adding to that volatility in markets.
Is it, higher rates, the higher rates that were already pretty much guaranteed from the Fed and the higher rates that we're seeing in these markets, are they going to make funding costs so expensive that it compounds, I should say, the depth of the recession we're looking at?
Yeah, I think it adds on to that sort of margin pressure that you're likely to see in companies. Yes, their funding costs are going to be going up. Mortgage rates moving through 6% in the US. If you're a corporate, you might have been, borrowing at extremely cheap levels, particularly at the junk end of the market. Now that's no longer true. You're going to be struggling to get that funding. So adding on to that, the energy costs which have moved up, and some of the various other sort of costs that have been moving up, wages, of course, looking pretty tight still. So I think it's going to be a difficult picture in terms of margins. And I'm not sure that's entirely in numbers yet, which is why we're, staying pretty cautious on the equity market overall.
Charlotte, thanks very much. Charlotte Ryland joining us there from CCLA. Coming up on the programme, we will turn full force towards the US CPI print. We'll talk to Steve Blitz, TS Lombard, Chief US Economist. He'll give us his perspective on the data to come. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with World Bank President David Malpass. That's at 7:30 a.m. in New York, 12:30 p.m. in London. This is Bloomberg.
So by moving at an aggressive but not an overwhelming pace, it allows us to get the funds rate up, to signal our commitment to keeping inflation in check and bringing it back down to 2%. But it also gives us some time to see how the economy is unfolding.
Neel Kashkari there, president of the Minneapolis Fed, speaking yesterday. Joining us to talk more about the Fed and inflation, the economy, is Steve Blitz. He is chief U.S. economist at TS Lombard. Steve, thanks so much for coming into the studio with me and Kailey bright and early. What do you expect, first off, from the inflation print today? And how important is it in deciding the Fed's moves going forward?
Well, the second part's easier to answer than the first, right? So not very much, right? Because the Fed always deals in 3-month moving averages, right? So it's going to look at this, and if it's a great print, it'll say, okay, this is good news, but we need to see this for another 2 months before we actually believe this is a trend. And secondly, most people, and then also I think, especially when you read through the minutes and you listen to what they're saying, the issue for them isn't inflation per se in terms of solving this problem. The issue is the imbalance in the labor market, right? And that, you know, that's 3.5% unemployment rate and 288,000 jobs per month. Which you think this is a great thing, but from the Fed's perspective, this is the root of the issue, and that you're not really going to get inflation driving down towards 2% until the unemployment rate gets up to 4.5%.
So 4.5% is where they want to go in order to control inflation. Those are their two mandates, right? Price stability and jobs. They have made it pretty clear that they don't mind if they break some things along the way, right? The market previously expected a pivot and even a cut, but now everyone we've talked to has laid out the fact that they're going to raise rates to a relatively high level, 4.5%, 5%, and hold there for a long time.
Yeah, well, first of all, you can't get from 3.5% to 4.5% unemployment without breaking something, right?
Yeah.
You just don't suddenly wake up and just drift to 4.5%. So yeah, something has to occur to get there. They're living on what they think is what I like to call their 4.5% solution, right? So if they get 4.5% or higher, the labor market is now working with them in terms of putting downward pressure on inflation. At a 4.5% or so funds rate, right, they're like in line with that against inflation, with inflation running between 4 and 4.5%. Now they've got unemployment above inflation, and they now have unemployment working with them, and then they could sit there in that position, right, and now they feel they've got all their stars aligned for inflation to go down, and then they'll follow, the funds rate will then follow inflation down, staying like, say, 25, 50 basis points above the inflation rate. But as my grandmother used to say, man plans, God laughs.
Yeah.
So
Well, and sometimes markets laugh too. The BOE also would like to fight inflation, yet because of concerns around financial stability, they're running into some conflict in the UK. And you could make the argument as well that the Fed ultimately is going to have to make a choice between financial stability and the inflation fight. Do you really believe the inflation fight wins when it comes down to it?
Yes and no. I think in the near term, the answer is yes. But that's also one of the reasons why you keep getting these sort of hawkish and dovish kind of comments from the Fed. The avenue to weaker growth is the equity market. But they don't want the equity market to crash. They don't want the bond market to crash. So, because then that puts them in the position where the BOE is right now. We're having to save markets so that markets can function with Sorry, not unemployment. Well, unemployment too low, but more importantly, inflation too high. So that's one of the reasons they're guiding. There's an awful lot of massaging and politics that's going on in a lot of these statements. But when you read through it, they're very clear in terms of what they want to do and where they have to go. But yeah, they do not want to create financial market disruption.
Steve, it's Anna in London. Good to see you. So in terms of the unemployment story, I know that today we're waiting for the inflation picture and we don't lose sight of that. But you've made unemployment a key part of the Fed narrative here. You've talked about that. Give us the long view here and your expertise on what is driving the labour market and the tightness, because you've pointed out that we're in the middle of some big socioeconomic changes post-COVID and that we need to reflect that. We can't necessarily expect normalisation back to how things were.
Right. So just that would take, an hour show.
It's a thesis, yeah.
But I think to keep it just on the unemployment, the problem with the unemployment market, or not the problem with the change in the unemployment market, is that the over 55 group, that employment population ratio dropped and was far below where it was in 2019, and those people aren't going back to work. Gen Z is coming into the marketplace now, in the labor market, but that's a smaller generation than the millennials. So you've got a lot of people left, which is really baby boomers and the older end of Gen X. They're leaving the market. It's a big number. Less are coming in. And in terms of importing workers through like H-1B visa, Trump and everyone, they kind of blew that up during his administration. And without making a political argument, good, bad, or indifferent, the fact is it occurred.
And it hasn't been unlocked.
And it hasn't been unlocked. Yeah. And it's very difficult, as you guys probably know, trying to bring an employee from somewhere around the world into working for you guys in New York is extraordinarily difficult now. So you've shifted the supply of labor. Mm-hmm. So you've got two choices then. Either you unlock the supply of labor, which is a longer-term issue, right? And that's something like Brainerd and everybody else is going to argue in terms of that's the ultimate solution to the employment issue. But in the near term, the way you break that is that you have to reduce the demand for labor.
Right.
Fed thinks it's 4.5%. Summers, Blanchard, others, myself included, think it's probably closer to 5.5%, where you bring that world back into balance.
So talking of how things are different post-COVID, the labor market, yes, but also what about just inflation? I mean, is a 2% inflation target no longer appropriate for the world we live in now?
Yes, and I think the Fed's going to get there, right? They can't get there now. They would just totally destroy their credibility if they said, what was so special about 2% anyway? Let's make 3% the target. So they put 2%.
Why that? I prefer 1% or none.
Or well, that's you. But I think what they'll say is that 3% is probably the better number, right? I'm the price to get back, to understand how we got to 2%. We had this incredible surge globally of supply of productive capacity, which was greater than the increase in demand because of the low income in China, Russia, Eastern Europe, and all that. And so you had 25 years of zero growth in CPI goods ex food and energy.
And now that's flipped on its head.
And now that's flipped on its head. And that's changed. And an awful lot because of economic security issues, what looks like a permanent upward shift in the cost of energy in Europe. All these things are bringing a lot of industry back to the U.S., which exacerbates the labor problem, because now you're looking not for waiters and busboys, you're looking for people who can work in manufacturing facilities.
Right. Steve, thank you very much. We appreciate your time. Steve Blitz of TS Lombard, thank you very much for joining us. Coming up, we will be hearing from the IMF Managing Director, Kristalina Georgieva, live from the annual meetings in D.C. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's take a quick look at what is coming up today. Italy's newly elected parliament convenes for the first time since the election. G20 finance ministers and central bankers will be meeting in Washington again. The House committee is investigating the January 6th assault on the U.S. Capitol and holding what its chairman says may be its final televised hearing at 1 p.m. New York time. But of course, today's main event, the U.S. CPI data at 8:30 a.m. Eastern Eastern. Matt, just about 2.5 hours to go.
Yeah, definitely be watching for that U.S. inflation print. It's really important, obviously, to asset prices today. It is set to show core inflation returning to a 4-decade high, underscoring the broad and elevated price pressures confronting the Fed. Our markets editor Valerie Teitel is in London to discuss why today might all be about the stickiest component of them. This is one you've really been focused on, Valerie, rental prices.
Yeah, that's true, Matt. Now, the Fed speak of late has made it very, very clear that the Fed is not going to temper their hikes until they're positive that core CPI has turned a corner and is headed down. Now, what is the main driver of core CPI? At the moment, it's rent. By last month's print, it now contributes up to 40% of core CPI, and even headline, it contributes over 30%. Now, this is a bit worrying because it's yet to peak, and we know that because it's so sticky, as soon as we do hit a peak, we basically draw a straight line out 4 quarters to see when it might turn a corner. Now, there's another reason why this is worrying, and I have a graphic to show you here, is that there is a debate about the validity of the Bureau of Labor Statistics data. Now, people are looking more and more at the private alternative measures of rental inflation, which just focus specifically on new rentals, which has skyrocketed over the BLS statistics. But most importantly, it has shown a peak. Now, because the Bureau of Labor Statistics was so concerned about this debate, they released a working paper, you can find it on their website, basically backing their methodology, saying, hey, we can back out this new tenant inflation data from our data set, but it comes at a 4-quarter lag, meaning we might see another a few more higher prints month on month until we start to steady out. Now, I'll leave you with this, Anna. Fed Williams last week compared inflation to peeling an onion. The first layer is commodities. The second is we eventually hit core inflation.
Okay. Excellent. There you go. So there are many layers to the onion is the point. And Valerie Teitel with the nice metaphor. I think we did it justice. We'll get back to that one after we get the inflation print, perhaps. This is Bloomberg.